Firstly, thanks to BBF for organising this. Thanks to the delegates for attending on this very beautiful morning. It's a shame to be stuck behind the screens. Just before we start, just a little introduction on both of us. I'm a corporate partner with, it says 20 plus years. Regrettably, it's getting closer to 30 years now of transactional experience, but regularly advise boards, directors and owners on complex structuring and restructuring. And also, having lived through 2 recessions in the past, have been through this type of situation before, slightly different now, but been through it before. So pass over to Simon.
Yeah, my background's a little different. I'm a litigator, a solicitor advocate, and I typically advise in relation to litigation, arbitration, shareholders, directors, unfair prejudice, director disqualification, all that sort of stuff. So both David and I sort of meet in the middle in terms of looking at the preventative side and also fixing the issues once they arise.
Okay, so I think if I just put the whole thing into context, and then Simon will take us through what we're going to discuss today. Clearly, we're in a sort of novel situation. Although we've been through recessions before, I don't think we've ever been in this type of situation where things have suddenly fallen off a cliff, and then there's been such an emphasis from the government to try and get things going again. The one thing I would say, and we'll touch on this time and again, the rules that we're discussing today are actually the rules that will have applied and will apply when we come out the end of this. It just so happens that now they get taken into the slightly sharper focus because of what's happening, but the rules are the same whether we're in periods of boom or bust. So what we're saying today is how you should be operating the businesses and what you should be thinking about in all times, not just now. As I said, the difference now is there's a lot of government aid to try and get people out of the issues that we're facing, whether that's Corona business interruption loans. Now, I know they've got their issues as to whether you can get hold of it or not. I was just looking in the press this morning to see that still very few loans have been issued. There's deferment of payment of tax. And there's also, and again, we'll touch on this later, there's the suggestion that wrongful trading is going to be suspended, and also some more insolvency provisions may be enacted with effect from the 1st of March. The problem we've got with that is there's very little detail about that. All that has been issued is a Commons briefing paper, and until we get the detail, it's very difficult to know what that will actually mean. And Simon, over to you for what we're actually going to discuss.
Yeah, so as we can see on the slide, we're going to start with some grounding, directors' duties, corporate veil, how that works and how they apply in general. We're then going to look at what happens broadly when insolvency comes to fruition. And we're going to look at the main tools the liquidators have to really look back at some of the transactions that directors are involved with afterwards, because the idea is that knowledge is power, and prevention is certainly better than cure. We're going to look briefly at director disqualification, and the extent to which we go into that will depend on time, I think, but the idea is to flag up when you need to worry and what you need to know, essentially. And finally, we're going to look at some practical guidance in the circumstances, taking account of the bits that David's highlighted, based on what we're seeing today and how we think can best help businesses. It's probably also worth me saying that David and I are both qualified in England and Wales, so that's what we're talking about today. And it's also worth saying that each of these situations differ, and particularly from my perspective, we can talk about trends and we can talk about general rules. And whilst there are often similarities in some of these cases, each sort of director circumstance, company circumstance really needs to be looked at in its own light. So although we're going to talk about trends, as I say, and give you some guidance, it's important that we don't treat it as firm legal advice. And in that respect, we're very happy to talk about specifics as and when you need. So do contact us if you want to do that.
Okay, as Simon said, we're going to start, which is where we've really got to start, with directors' duties. So 2006 Companies Act codified everything, so it's actually written it into the Companies Act, taking over from what used to exist, which was effectively a mixture of common law and some other guidance given by judges. Important thing to note is these are duties which a director owes to the company. They're not owed to group companies, they're not owed to any individual person, they are owed to the company as a whole. And the other thing to remember is the company is a separate legal entity. If you're trading through a company, you've got to play by the rules, if I can put it that way. These are the rules we're talking about. In good times, it's often the case, excuse me, that you will find, for example, some personal expenses being paid by the company during the course of the year. Technically, it shouldn't be done, but it all gets wiped out at the end of the year through the accounts. The issue you've got, if something goes wrong in the meantime and the company goes down, those personal expenses having been paid by a director could end up with the director facing embarrassing and difficult questions from a liquidator. So just dealing with those specifics and going through them reasonably quickly. The first one is the directors, excuse me. The first is that the directors have got to act within their powers. What powers do you have? It will be set out in the Articles of Association. The Articles of Association will set out any additional powers or restrictions, but that's important. The most important issue, and one that we'll be focusing on time and again, is the duty of directors to promote the success of the company. Now, when they drafted the Companies Act in 2006, they actually went on to set out the factors which should also be considered. And those include, and it's very important to say include, but they're not limited to, the long-term consequences of any decision, the interests of employees, the need to foster business relationships, so relationships with suppliers and so on, the impact the decision may have on the community and the environment, the desirability for the company to maintain a reputation for high business standards and conduct, and also to act fairly between the members' interests. So all those issues are what should be taken into account when directors are taking decisions which affect the company. Now, for people who have used solicitors to draft board resolutions, you will often see that there is a very brief thing saying the directors haven't taken into account their obligations under Section 172 of the Companies Act. That's what it means. You're meant to have thought of all of those things. And something that Simon and I will touch on later is going forward, now is the time to actually record properly why you're taking decisions, but it is something we'll come on to towards the end. The next one, exercise independent judgment. So again, don't allow yourself to become fettered or restricted by someone else. As a director, you've got to do it independently. Simon, you've got something I think you might mention there.
Yes, well, I think it's useful to tie these sort of abstract rules to a real situation. And some of you might have come across some media interest around EasyJet. We all know that airline industry is going through a difficult phase, as are many businesses. But the reason this is interesting is because EasyJet, it's been reported, are due to spend a significant amount of money on something like 100 odd new planes. And they're due to spend that between 2020 and 2023. And I think the aim was to expand their fleet quite considerably. Now they've come under, the board, I should say, has come under significant pressure, and rather public pressure, from one of their majority owners. I should say is a minority, but a significant minority owner. And a letter was written by one of the shareholders to the board, effectively saying, continuing with this proposed purchase is a very bad idea for a number of reasons. And if you don't listen to me, I shall call a meeting of the shareholders with the purpose of firing each of the directors until you listen to what I'm saying. So it's a rather extreme attempt at getting the board's attention. It may well be that the decisions, the the thought process behind what they're doing is sensible, but clearly the board has to make its own decision, as I'm sure it's doing, and not be openly swayed by external pressure.
Directors, thanks, Simon. The next thing is directors have got to act, or they've got to exercise reasonable care, skill, and diligence. There's two tests here. There's what you would be reasonably expect from someone doing the work that the director was doing in relation to that company. So that's the objective test. But there's also a subjective test. So that's looking at the general knowledge, skill, and experience that the director actually has. What that means in real life is that if someone is an accountant, for example, and is sitting on the board, they may have an additional assumed level of general knowledge, skill, and experience related to cash flow, debt collection, numbers, and so on, over and above someone who may have great experience in, for example, health and safety. Health and safety person, though, would be expected to have more knowledge than the accountant on the health and safety side. So there are two tests when it comes to seeing whether you're doing your job properly. What should a normal person do, and what should someone with your increased experience do? The other two or three, just go through quickly: duty to avoid conflicts of interest, a duty not to accept benefits from third parties, and a duty to declare an interest in proposed transactions. As I say, all these duties apply all the time. The ones which are more important now, I suppose, is really promoting the success of the company, exercising independent judgment, and exercising reasonable care and skill are the ones particularly in focus.
It's probably, if I can just jump in quickly and say, it's worth at this point flagging that one of the big questions we get is how these decisions should be documented, because directors often say, well, it was just a decision we made, it wasn't a formal decision. And I think what's important is to recognise that any decision made is sort of quote unquote a formal decision. And when you're thinking about how those will be treated later down the line, think about recording them as resolutions or having them as minutes. And as David said earlier on, if the sort of prevailing view is that if you explain in the minutes that you've considered the factors that he's talked through, that's probably a good starting point. But the more significant the decision, I think that the more benefit will be gained by making it expressly clear what you're doing and why, because it's showing what you did at a point in time, back in time, that really is the challenge in most of these situations. Anyway, David,
yeah, just one other point, actually. It's often the case that directors will be wearing many hats when taking decisions. You are potentially a director, a shareholder, and an employee. Your duty as a director is as a director, so you shouldn't be taking decisions which, and again, we'll come on to this later on, which are to your advantage as an employee or to your advantage as a shareholder. It's got to be decisions which are the interest of the company as a whole, and you've got to remember that when taking the decisions. There will be conflict between those interests. So going on to the next, which is I've put it up, Simon. Do you want to start on this?
Yeah, absolutely. Why is this important? Fundamentally, because it creates liability for all directors. If there is a breach of the duties owed by a director to the company has the power to enforce those. There's lots of law on this that we're not going to go into now. We could talk about derivative actions and all sorts of things, but the main point here is that it creates potential liability for the directors. And if the company is taken over by, for example, administrators or liquidators, somebody else is in control of that entity, and it could turn around and look at recovering any damages. And the remedy is usually damages, but it could be injunctive, it could be to set aside a transaction that's particularly difficult, or it could be for an account of profits if there's a conflict of interest. It's very wide, but it puts directors in the frame. So that's why it's important, and that's why we're talking about why these things need to be looked at in these circumstances.
I think the thing to point out, though, there's various ways of rectifying breaches or ratifying breaches. The Companies Act recognises, I suppose, that things are not always going to be done properly. So there are sections which allow the company, that's the shareholders, sometimes the shareholders and directors are the same people, but this is acting with your shareholder hat on, they can ratify or condone the director's conduct. That can be a little bit tricky if you are a family company or very few outside directors, because you've got to be careful that you're not getting a vote passed simply because the person who did the wrongful act voted in favour of it. So again, it can be done, but you've got to do it properly. And also, if there are proceedings brought against directors, then there's another process in the Companies Act which allows, if the proceedings were being brought for negligence, default, breach of duty or breach of trust, then the court can say that the director should not be liable if it considers, firstly, that the directors have acted honestly and reasonably, and secondly, considering all the circumstances of the case, that the directors ought fairly to be excused. Now, it may often be used as a defence to any action, but I think it seldom succeeds.
Yeah, that's certainly my experience.
Yeah, and the other thing, and again, we'll touch on it in a little bit, it may be that you have or can get directors and officers indemnity insurance, which again can cover the costs of any defence action, provided that you're successful. I think before we go on to these, and there's just, I'll pick up this one question because it's been asked, if that's all right, Maxine. I've seen a question asked. So I think someone's asked that you've had to furlough one of the directors. Do you need to minute that? I think it would be sensible to say why the particular director has been furloughed. The important thing, however, is the director doesn't cease to have these director's duties. You're furloughing that person as an employee. And the new guidance that came out, I think it was last weekend, specifically says that a director is still allowed to work for the company if he is, or work on the company's business, if he is performing his statutory duties. And these are statutory duties. So just furloughing a director does not necessarily get him or her out of the obligations that we've just discussed on decision taking. Indeed, if there's any directors' meetings, in my view, that director should still be present at those meetings.
Yeah, I think it comes down to the point David made, that it's important to think about the hats that each person is wearing, because there may well be an employee hat in which, and that's the context in which the furlough hits, but as wearing one's hat as a statutory director, it's likely that obligations still exist. So I think the ultimate point is to think about how it would impact the company. Clearly, if there's multiple directors, the ability of the company to continue trading may well be unimpacted. It may be a sensible cost-cutting measure. That would certainly be worth minuting, I suspect. But for the perspective of that individual director, I think David's right. It's important that they understand their statutory duties may not be limited simply by having been furloughed.
And if you need more details on furloughing, and it's not really either my area or Simon's area, I know that on our website we've got, and there'll be details of the website later on, there's quite a bit on furloughing. So if you do need more on furloughing, by all means, look at the website. So all these duties we've discussed apply good times, bad times. We're now in bad times. So why is it more important on insolvency? Well, Simon will come on to that. The first thing is to know, when are you actually insolvent? And the question on that, there's two tests of insolvency. One, you're either a balance sheet insolvent, which really doesn't apply now. If you're balance sheet insolvent, largely speaking, what's happening now will not have made a difference. More important is cash flow insolvency. And that really means that you are unable to pay your debts as and when they fall due. So if that happens, technically, you are insolvent. So if, for example, you have a lot of suppliers who are looking to be paid, but you have customers who are not paying you, so the two don't balance out and you can't pay those, technically you may be insolvent. And that's got to be taken into account when you then think about these issues, which I think Simon's going to come on to.
I think the first point to make is that the duties of individual directors still apply. So from when the company is trading successfully and happily to when the company is trading unhappily or even very unhappily, directors' duties still apply. I think the important point to make is that in relation to promoting the success of the company, the duty to act in the best interests of the company's members is displaced with an obligation to act in the interests of the creditors when the company is insolvent. And knowing when the company is insolvent and when it's not is obviously a question of finance and can be quite difficult to predict or indeed monitor, and that's really why these points are relevant. Before the company is sort of definitely insolvent, it's in a questionable state. So the duty on directors is to have regard to the interests of creditors as the company nears insolvency. And the big question for lots of people is, when does that duty actually switch from one owed to the shareholders to promote the business to one that is looking at preserving the assets for creditors? The answer is that the precise point is going to be specific to any particular company and is very difficult to set out in stone. There are lots of decisions by judges that talk about how that decision-making process is assessed. The best way of putting it, I think, is that the essence of the test, and I'm quoting here, is that directors ought in their conduct of the company's business to be anticipating the insolvency of the company, because when that occurred, the creditors had a greater claim to the assets of the company than the shareholders. Now, that's the main point. Now, it's worth moving on and looking at fraudulent and wrongful trading, because these are much publicised provisions. Wrongful trading in particular has been talked about in the press quite a lot. In practice, actions brought against directors for wrongful and fraudulent trading are generally less common than other provisions, largely because for the incoming liquidator, there is a significant amount that can be claimed for a simple breach of directors' duties, and it's often not necessary to go further and prove wrongful trading. But we'll look at them very briefly. Wrongful trading is when a company is insolvent and directors knew or ought to have known or reasonably known that it wouldn't avoid insolvency. So they're under a duty to take every step which a reasonably diligent person would take to minimise the loss for the company's creditors. Now, if you don't do that, then there's a risk of personal liability, effectively for making the creditor position worse. Now, that's wrongful trading. And as we know, as part of the governmental response, I think it was on the 28th of March, they announced that the wrongful trading provisions would be temporarily suspended with effect from, I think, the 1st of March. So for an initial 3 months. Now, as I understand it, we are awaiting the detail of how that would actually work. I suppose the practical impact of that for directors, if there's one message that we could pass on, I think it's, don't assume that that means you are free, because there are many routes of action that liquidators or administrators can use. And even if wrongful trading is suspended, the reality is, I suspect, that anything a liquidator wants to recover from a director who's caught in a difficult position can be recovered by other means. So it may be somewhat of a political posturing move. There may be some more in the detail when it comes through, but we shall have to wait and see.
I think it's So I mean, I think it's fair to say that wrongful trading really is out to get the, if I can put it, the crooks who just keep racking up debt after debt after debt with no intention or no thought that they're ever going to pay people off. That's really what wrongful trading's looking for. It's those people who go the extra mile. The normal director who gets caught in a difficult situation, it's unlikely that the administrator liquidator will be going for a wrongful trading against those people.
Yeah, it's also generally quite difficult to prove. And in circumstances where, for example, a liquidator comes into a business, they have a limited pot of assets, a pot of money to spend in recovering that sort of action. Do they want to go that far? The circumstances in which they do are generally rare, which is why David says it's often geared to the more serious of the situations. Let me run briefly through fraud, because that's wider. It clearly is, I suppose, what it says on the tin, but if in the course of an insolvent winding up, so an insolvent situation for a company, it appears that any person, so it's very, very wide, who is or was a director of the company, sorry, I'm actually quoting the wrong place. If in the course of any winding up, it appears that any business of the company had been carried out with the intent to defraud creditors or for any other fraudulent purpose, a liquidator or an administrator can seek a declaration that anyone who was knowingly a party to the fraudulent business make a contribution to the company's assets. So this applies to anyone. It looks very, very specifically at circumstances that are dodgy, for want of a better word. It's unlikely, I suspect, to be an issue for many of our directors and listeners today, but it's worth bearing in mind. So fraud has very wide powers. What I will jump onto is misfeasance, because this is by far the most common, in my experience, cause of action that liquidators pursue. And we're dealing with circumstances where if, for example, a liquidator thinks that any present or former director, and the former director is important because resigning doesn't get you off the hook, has misapplied or kept hold of, or the words used are become accountable for, so cause the company to lose assets, for example, any money or property of the company, or have been guilty of any misfeasance or breach of any fiduciary or other duty. So we're talking there about breaches of directors' duties. The court can make an order that the director repay or restore or account for the money or property with interest to contribute towards the company's assets. So very, very wide powers that allow a liquidator to claw back money or assets if there are breaches of, for example, directors' duties that have led the company to suffer loss. So really it's a case of being aware of these things. As I say, they're much wider and they're generally easier to prove and they're far more common. Now, I think it's worth a comment on personal guarantees, but I think, David, you're best placed to talk about that.
Yeah, I mean, it's common knowledge that banks in the recent past, probably from 2008-9, have been reluctant to lend to businesses, big or small, without, in many cases, directors having to give personal guarantees. And I think it's just a risk, and it's important that people go back and look at those personal guarantees that they may have given to the banks in the past. Because if the company fails, or if the company does not repay money which is due to the bank or any other funder, those personal guarantees could start to be called upon. Now, it depends how the guarantee is drafted, and there's multiple ways of drafting the guarantees. But some guarantees, which are very harsh, but still quite common, effectively say you will be liable for whatever money the company may owe to the bank, now or in the future. And even if the company pays that money back and then reborrows, you are still liable for that money it reborrows. So even though it went into the black and then goes back into the red, you're still liable if they make a claim on that guarantee. Some guarantees do not give directors any rights to crystallize the claim against them. And it basically says you stay on the hook until we let you off. And it's our discretion as the bank or the funder whether we'll let you off. So those guarantees have got to be considered. And this is the interesting thought, again, of different hats, because that is a liability on the director as an individual person, not as a director, but just as an individual person. That person doesn't want the guarantee to be claimed on. They may think, and it's something we'll come on to, but they may think, I know what we'll do. We'll repay the bank first. That's not a good idea because that could have problems unless they're secured. It's something we'll come on to. But personal guarantees should not be forgotten about. And just one other thing, I know we're mentioning the concept of insolvency, and people will say, oh, insolvency, that means there's only one option. We've got to go into liquidation. Actually, possibly not. The duty is owed to creditors. You've got to look as to what the best result will be for those creditors. There's not that many buyers around at the minute. So it may well be that actually going into liquidation and ceasing to trade is not necessarily the best result for creditors. It may be, and this is where you need specific accountancy and solvency practitioning advice, it may be that it's best to continue trading a little bit so that you can actually collect the debts which are owed to you, because that gets a better result for creditors. Having said that, directors have got to be very careful, and again, something we'll come on to a little bit more, whether you accept all the bank loans available. You've got to think, am I going to be able to repay these loans? Apart from furloughing, which is a gift, effectively, everything else is just loans. They may be deferring the payment of it, they may be deferring the interest, but they are loans with obligations to repay. So directors, when they take those on, have got to be sure that they believe that they can trade out of the current position and repay those loans. So don't just go and grab everything there. And I think if we go on to the...
It's a good point.
Yeah.
Because the reality is we want to be thinking about the worst case scenario so that we can avoid it. And that's really what today is about. And if the worst does happen and we find ourselves in an insolvency situation, what powers do liquidators or administrators have? And I suppose the big point here, we've listed a few of the examples on the slide, but there are a number of types of antecedent transactions, transactions that can be reviewed by the liquidators retrospectively and unwound in an insolvent situation. Now, we've listed some of them. We've got transactions at an undervalue, transactions that preference particular creditors, invalid floating charges. We also have extortionate credit transactions, contributions from past directors and shareholders, transactions defrauding creditors. There's a very long list, but the ones we've set out here are probably the most relevant for today. I should say the overriding aim here is that once the business is insolvent, it's about protecting creditors, and the aim is an equal distribution of all of the assets to creditors. So anything that offends that as a general principle is likely to be reviewable. So that's what directors need to be thinking about when they're paying off banks, when they're returning loan payments, maybe when they're injecting emergency capital into the business. If I get that out, am I going to be putting myself at a preference risk? All those circumstances are what we're trying to flag up here. What I'd like to do is just look at three very briefly, because it's not always clear what they mean. If we take a transaction at an undervalue, an administrator or a liquidator can ask the court to set aside or make an order in relation to a transaction that they say is an undervalue if, for example, there's been a gift or a transaction was entered into at arm's length and the company didn't receive any consideration, any money in return. or maybe it entered into a transaction which is significantly less in value than it was worth. We're usually looking at a 2-year period before the company went insolvent. And generally speaking, the company was unable to pay its debts at the time of the transaction, so cash flow insolvent, or that transaction made it become cash flow insolvent. So things that have happened that caused the company financial difficulty. And we're often looking at things like selling off assets below market price. It may be in an attempt to get cash in to allow the business to keep trading. We just need to have an eye on those situations and be prepared to explain why it was good value or why it was necessary. Often directing the company to agree to supply goods without making payment, for example. Maybe payment goes elsewhere. Is there a group structure, another company that's getting a benefit? We need to be prepared to explain these circumstances because they all are, on paper, at least vulnerable. Directing the company to write off loans. You know, if I, as a director, have given a company a big loan, and then I instruct the company to write that loan off, you know, so that I don't have to repay it, it's likely to be considered as a transaction under value unless I can explain why there was equal benefit. So just things to be aware of. Moving on and looking at preferences, it's probably clear now what we're looking at, but a company gives a preference to any person if, for example, they are one of the company's creditors, or they are, for instance, a surety or a guarantor for the company's debts. If the company does something which puts that person in a better position than another creditor. Again, the transaction needs to be influenced by an intention to prefer one creditor over another, which is a rather subjective thing and something that's often used as a defence. The difficulty with that is in many circumstances, the rules assume that there has been an intention to prefer because of what has happened. So it can be quite difficult to defend those situations, although not impossible. And again, the company needs to be either cash flow insolvent, unable to pay its debts at the time, or became cash flow insolvent as a result. So again, things like repaying loans made by directors or directors' family when the company starts to look like it's in difficulty and they want to get their money out. Everyone takes money out in a sort of panic move. Those situations almost always cause difficulty. And actually, what we need to be doing is just thinking about how best to manage those situations.
I think, Simon, just on that, and it's a good point to jump in here. If the company does need funding to go forward and you decide to fund it yourself as a loan, that's great. But don't just assume that once the money's in and the next bill gets paid, you get your money out first. That's where you would have a preference.
Exactly. Yeah. Another bit worth flagging is floating charges. The rules on this are a little convoluted, but in short, there needs to be consideration for a floating charge if you want to secure assets that way. And let me just exemplify it by painting this picture. If we assume that Director A has already given company a £1 million loan facility, and that's unsecured, he then, or she then, 6 months, 8 months down the line, wants to give the company a further 200,000 loan facility. They want to extend that from 1 million to another 200,000, and in principle they want to take a floating charge. They can do so when they grant the 200,000 extra facility in relation to only that facility. What they cannot do and expect to rely on, I suspect, is try and grant a floating charge over the entire 1,200,000 facility, because that is an area that is likely to cause difficulty. Now, none of that means that we can't look at fixed charges, but it does mean that when we're looking at security and particularly securing director investment, we need to be a little bit careful. It may be that David has some further comments on that and on loans and dividends specifically. David?
I think that, yeah, on the floating charges, it's not uncommon in acting for administrators and liquidators. The first thing they do if there's a floating charge around is look to see whether or not consideration was paid. It's not as though it's only in extreme situations. That's the first thing they do. And if I'm reporting back to a liquidator administrator, that's the first question I will ask. I'll say there was a floating charge created on that date. What consideration was received? Otherwise, it may be able to be challenged. So it's not an unusual thing. And again, it's just having more resonance now because of the situation we're in. I think we've got to recognise that many companies pay their directors by way of a small salary and dividends. That's how 90% of small businesses, I suspect, do that. That has some disadvantages which are currently coming out. And again, I'll come on to a couple of those. The first thing is to be able to pay a dividend, the Companies Act is very strict. A company must have profits available to make the distribution. And the distribution must be justified by reference to relevant accounts. Now, if the profits are not there now, there may be a problem if you pay a dividend, the company goes insolvent, a liquidator will look at those dividends which have been paid recently. And if the profits were not available when the dividends were paid, those payments can be claimed back from the person to whom the dividend was paid. And I know there's great reasons for doing it. The other downside, clearly, at the moment, is on the furloughing. If you furlough a director, and that director has been receiving the majority of their income by way of dividend, that does not count when calculating how much the person should receive under the government furlough. That is leaving a lot of people short, and is leaving, I think that's one big part of the business community that has been forgotten about here. Because yes, there's the help for the employees with the 80%, but where that person has, in theory, taken advantage of a situation to pay themselves by way of small salary, large dividend, all that counts is that 80% of that of the small dividends over the past, I think it's 52 weeks. So again, just something to be looked at. If you have been paying yourself by dividends, ensure that that is still a valid payment to make. And the other one thing, if shares have been issued nil paid, which sometimes happens, there's various reasons why it's done. If a company goes into liquidation, again, the first thing a liquidator will do is look for easy money, and that's easy money because shares are issued, if they're issued nil paid, it's with a promise that when a call is made on these shares, you've got to pay up the money that's due on them. So again, just check whether there's any hidden potential liabilities like that around. And Simon, have you got anything on void dispositions?
I think not a lot. What's worth saying is that if the company is presented with a winding up petition, and it's something that usually you will know because there will be a statutory demand that comes before it often, but not always. But if the company is presented with one, then you're on notice, legally speaking, that somebody considers the company to be insolvent. And the difficulty we have is that the failure to comply with the statutory demand is treated in law as evidence of the company's insolvency. Now, if one is insolvent, then you have an obligation to preserve the company's assets. So what this means in practice is you may well have a company who's continuing to trade, needs to continue to trade and pay suppliers and pay salary, all these things. But all of those sums become vulnerable to recovery actions by liquidators if we're presented with a petition. Now, the specifics of the claims they might bring will differ, but some of these payments can be automatically void under section 127, as we've highlighted there. Now, the reason we're talking about it today is just to flag that if you are presented with a winding up petition, you need to be alive to the risk that if you need to keep making payments, there is a mechanism to apply to court for validation orders. It can be done retrospectively, but it's much harder. It's far easier to do that for essential supplier payments than it is for payment or repayment of directors' expenses, for example, because what you're looking at is what's necessary for this business to survive. So just to flag that, I don't think there's anything more we need to say about that. David, I think just a word on disqualification. The point here is that when an insolvency practitioner is appointed, or when an administrator is appointed, or a liquidator, they are required to make certain reports to the Secretary of State, and those include circumstances that appear to satisfy the definition of the test for the disqualification of directors. Now, I'm going to run through the test very briefly because what is important is that when assessing that conduct, the court is entitled to judge a director unfit in circumstances where he or she is looking at the cause of the company's insolvency, either in isolation or taken together as part of the director's conduct. And what they often look at in terms of factors includes things like any misfeasance or breach of any duty, or any material breach of legislation that's essentially relevant to that director. So the point is that if the liquidators are looking at potential breach of directors' duties as a means of getting money back into the company, they will also have to report on the very same circumstances to the Secretary of State as examples of conduct that may warrant a disqualification order. So often what we see is not only an obligation to defend against the immediate recovery of money from a director, for example, but the knowledge that actually in the future, maybe a year down the line, it may be 2 years down the line, depending on efficiency, all that stuff, a possible disqualification process happening. So we have to factor those in. And that's why it becomes more important for directors to be aware of these risks, because they are becoming far more common than they were 3 or 4 years ago.
And then really practical guidance, and we've touched on most of these, just a quick run through them. So check whether you have got any directors and officers insurance, liability insurance. Evidence the decisions that you're taking. Why are you taking the decisions? What supporting evidence was there for taking those decisions? Rectify any obvious issues, such as the issues with securities. Be aware that sometimes your duty may become a duty to creditors rather than the company as a whole. One that I've touched on earlier, take advice before you inject the funds. If you put money in on a short-term loan and then repay it before other people who have lent money, that may well be challenged if the company doesn't successfully get out the other side. I think that the last two, Simon, if you want to pick up the last two on those.
Yeah, absolutely. I think the points are there on the slide. It's best if you prepare for the worst eventuality. Assume that the decisions you make may be looked at. If we are saying, right, we need to write off this loan and there are good commercial reasons for it, then put those down in a resolution or meeting minutes, have them ready. If we've paid dividends, then be prepared to explain why the company was in a position to pay out dividends based on distributable profit. If you're presented with a winding up petition, don't ignore it, because that's the worst thing one can do. It's far easier to deal with these things in advance. The reference to validate is, you know, an application to validate those payments that can be made. So I think, yeah, think about what might happen, and it will allow you to, I suppose, make best plans to avoid it. And it's probably also worth saying that if you're uncertain about the company's position, then take advice, whether from an insolvency practitioner, an accountant, or a law firm, and record that you've taken advice, and, you know, think about it and adhere to it, I suspect, because what you're looking at is layers of responsibility. It's probably responsible for a board of directors to take external advice. A decision becomes far easier to justify if that advice has been taken and followed, because not everyone is expected to be an expert in every area. So yeah, David, I don't know if there's anything else that you...
No, that's it. I suppose we could do the question and answers. One other thing, and again, just reading recently, there's a potential new solution for companies, which is a light touch administration. Now, the problem is this is being spoken about by a lot of administrators. People are waiting for guidance to come out on it, but the hope process is it will almost allow a company to be put into deep freeze, for want of a better description, so that you can stop doing anything almost for 3 months, if not a little bit longer. The hope is that the administrator will then be able to give the powers back to the directors to operate the company on their behalf. It's really only appropriate where you can stop the company, where almost you have fallen completely off a cliff, there's no business at all. It's something to consider with an experienced insolvency practitioner. It is being thought about. I think it will be implemented. I think someone suggested to me that Debenhams may be looking to do a similar type process. It is new. It doesn't exist at the minute. The concept exists, but how it will actually work in practice is being worked out on the hoof. So if there's any questions...
Or indeed, if anyone wants to talk to us after the presentation, then you have our contact details, and it may well be more appropriate to have a specific discussion about particular circumstances. So for anyone who feels that that's a better forum, then, you know, please do get in touch.